Yeah. I need some of those bilateral beats. Is that what they're called? Binaural beats. So I need to add in my latest trade. Over here. Put it in. Because I made a trade here recently that I thought was kind of fun, kind of cool, kind of interesting on XLF. And it was a 0 DTE trade for a small credit, which seemed to work out pretty well in my favor. So I was really excited about that. Go back to that 8. Oh man, it's yawning. Not gonna be on here. These guys are in the money. Hell yeah, my verticals. They expire this week. Should probably go ahead and close those out. Let's see if I can grab it again. Huh. Interesting. So, with that out of the way, come over here. I know it was 7-8. Model fill, cool. 708. The strike, if I can pull it up, that's not what I need. I need to trade. Oh man, those yawns are killer. One second, I know what I can get. I don't know why I seem to like my phone better than the computer version, but Thinkorswim always seems to just do me better. Always seems to do me better. I just understand it more easily, I guess. Let's go right here. This is it. Would you look at that? So, what I did on Friday was I sold to open a short put on my guy. See, I didn't get the delta. I think that's so that's a mistake. That's a pretty big mistake. 0 days in trade, debit to close. I closed at and this guy, same guy, 3 cents. So it was 0.03. So I made a 10-cent credit. 0.03. Oh no. Okay. So the way to figure that out, actually, maybe might be to do on demand. but I can go back and fill that in. Just as a rough estimate, I think it was at a zero point 0.4 delta. Like I said, that's a rough estimate, but just for the sake of keeping us moving, we're going to pump it up to a 0.4 and then come back to that here in a little bit when I can get some more data on that, or actually look it up, because I can make this up. We'll go on demand. Thank you. And let's see if it'll let us jump in. Oh, it will. Let's go. That's awesome. So we're gonna bump way back down here, and I open my order at 9:58. So I was really in this trade. So I opened this trade at 9:05 a.m. and I closed the trade at 10:16 a.m. So I was in this trade for a little over an hour, an hour and a few minutes. So it was really short. It was a really short, intraday trade, but I made an easy 10-cent credit off of that, which, just for doing it on the spot, and really testing things out, I guess, is more so what I was trying to do there. I made a decent profit, So if we go to trade, and it was the 32 right here, delta was 48, so I wasn't too far off. And then looking over at that, so we've made that's not right yet. Zero that one out. And actually, I can update this. So we got boom. So we'll just drop this down. So I made a nice 76, 77 roughly percent return on invested capital. So that's not bad, Like I said, especially if we're just trying things out, it worked. It worked out pretty well for me, and I like that. So I'm content with how the overall trade worked out. Is this something that I'm going to keep doing? I would like to think so. Just because the way I see it right now, I have my longs out. I have 341 days to expiration. So I have plenty of time. On the short side, I have my one call, or my one put, short put out. And according to the strategy itself and on the calculations, I can place up to 2 trades. And it's not at a ratio. It would be, at a 1-to-1 ratio at this point. And, you can see when I had both of these on, it was 2-to-2, which really I have it 2-to-1 as of current. I have it 2-to-1. So I have it at a ratio on the long side. So that way I'm not capping the upside. And I want to keep things that way. But I just thought it was interesting that this was showing that it was 2 here, and I would be okay, according to my calculation. So why not give myself a little bit of leeway on the shorter time frame and see if I can capture some cash that way. So, like I said, with the longs having so much time left to expiration, and on my short side, I have until 19 AUG, and I think that's roughly 40 days now. I can pull it up and be exact. Yeah, it's actually 40 days. I have 40 days till expiration, And the way that I have this set up right now, so since I'm going on vacation here soon, actually I'll be on vacation this next week. So I won't, or I may not actually have a whole lot of time to be messing around and managing things and trying to keep an eye on things, while I'm just busy and running around on the beach. So I left this with plenty of time to theta decay and just let it bleed out slowly. It's fine while the market does its thing and letting the long calls hopefully appreciate. So since I have it set up that way, I don't have to do a whole lot of management. And since I'm collecting the premium up front, but I have a decent amount of time to expiration, I can really just kind of sit back, let things bleed out, and just keep an eye on things, in case anything goes crazy, then I can step in and start to manage that way. But otherwise, I'm just gonna let it do its thing, let the trade play out and just be patient with it. But on the other side of the coin, I want to be a bit of a degenerate gambler and see if I can make quick money. And I can do that, that's fine and all. But I want to do it in a calculated way. So, in a calculated way would be for me to do it on this way. 0 DTE, same day expiration, just selling that put up front, collecting a small, it's going to be small. That's just how it works. And that's fine because, let's say I were to do 10 of these, that's $100. And if I did that 10 weeks in a row, I would still have a little bit of time left on the long side of things. And if all things considered it went perfectly every time, then boom, I'd have $100 credit. That would be kind of cool. So I'm not sure how that'll affect my expectancy yet. That's something that I need to keep track of. So like I said, I'm just going to keep track of it and see how it plays out. Other than that, I don't have too much going on with the position. Some things that I want to look at. Yeah, a thing that I want to emphasize too is that I really, really feel like I need to emphasize and dig into my brain is the damn calculations. These two guys right here. Adjusted cost basis and critical strike. These are the two most important, I would say, aspects of the diagonal strategy, whether you're doing calls or puts. I really feel like it's something you gotta know, man. And that's something that I've been working myself on, at the adjusted cost basis. So what the adjusted cost basis is, it's the sum of your buy to open, so the sum of the debited longs positions, so it could be long calls or long puts, and here I have long calls. So it's the sum of your buy to open long position plus the sum of your buy to close short position. So it's the sum of the buy to open of the long side, and then it's the sum of the buy to close of the short side. So in this case, it's the sum of the buy to open here, so 580 of my long position, plus the buy to close position of my short side. So in this case, it's my buy to close is 0 just because I haven't bought to close anything yet on the long side, but down here it's 0.03. So if I were to do that, if I actually, let's duplicate this and tinker with it. So if I were to do that, you can see my adjusted leap basis. So L4 is the total sum. So since it's I paid 580 for one, it's times 2. So 580 times 2 is 1160. So 1160 plus K12, and K12 is here, but I also have this one. So we're gonna do K12 plus K13 here. 21. Boom. So we'll have that there, K12 plus K13, because both of those are there. And the debit to close right now on my 19 AUG position is 0, just because I'm not closing the position yet. If I wanted to get a good idea of what it was, I can go and check it out, and we can check it out together. So coming over here, you can see the position right here. And if I wanted to buy to close, be 72 cents. So come over here, 0.72. Boom. So that's my debit to close right now. And you can see how it affects my adjusted basis immediately. Having it here, it's 1160. Having it here, it's 1235. And it goes up based on the debit to close. And so the next part of it is, so it's the sum of your buy to close long position plus the sum of your buy to close short position minus the sell to close of your long calls. So sell to close, long put credit. Ooh, that was a mouthful. Come over here, and if I wanted to close these guys out, we'd be looking at 555. So if I put 555, big yawn, man. These yawns are killer for me this morning. I took a cold bath and everything. So we can see that we have the sum of all the positions here minus the sell to close long position. So in this case, it's long puts. So sell to close long puts. And we have it right here. It's going to be 555 times 2 is what? 1110? Double check the math, because I'm not the best sometimes. It's early. Yeah, 1110. Cool. Boom. So once again, it brings my basis down a little bit, which is cool. And then come over here. So we have the sum of the long position, sum of the short position, minus the sum, or the sell to close of the long position. And then you divide all of that by the number of long calls times 100. So coming back here, so we have G7 as the number of long calls. So we're going to take this whole equation here, which is the sum of the long positions, the sell to close sum of the short positions, and then the sell to close credit of the long position, and then multiply or divide it by 2 times 100. So it's just 200. So it's going to divide by 200. And that comes out to 1229. That's my adjusted LEAP basis. That's my operating or cost of this position. So on my critical strike, it's going to be the adjusted cost basis minus the current long call premium divided by the long call delta. So adjusted cost basis minus current long call premium divided by long call delta. So the current current long put value, or the current long put premium, that's hard to say, is 555. So we're going to take that, we have it right here, so it's going to be my critical strike is going to be my adjusted cost basis minus current long call premium divided by long call delta. And in this case, I have the stock price up here because it's different for puts rather than calls. You have to calculate it a little bit differently, and I can't say 100% this is the right way to calculate it. I feel like that's the best way to put it. But this is something that's a work in progress. So if we just come over to this example, because this is a better example, you have the current long premium, which is H4, the adjusted long basis, H4. So that's your 1040 here, minus the current long call premium, or just long position premium. In this case, it is calls, so minus F4, which was the current value, 660. So you have 1040 minus 660, and then you divide that by the long position delta. So in this case, it was 0.88. So 1040 minus 660 divided by 0.88 plus the current stock price. So that's actually something that I didn't have in here. It's that whole position plus current stock price. Yeah, we're just going to do a money sign, because a money sign is much cooler. I have one more parentheses there because that's how it's going to work properly. Boom and boom. Boom. Okay. So adjusted cost basis minus current long premium divided by long call delta plus current stock price. And you can see all of that here. And then if you jump over here, you can see that for the put side. So like I said, it may not be 100% right, but it is the same method, just calculated a little bit differently. So we have the current stock price minus the adjusted LEAP basis, minus the current long premium value divided by the long delta. The reason why the long pause there, I have the current stock price. It's not the current stock price minus the adjusted LEAP basis. It's the adjusted LEAP basis minus the long value, or value premium value, either way how you say it, divided by the long delta minus the current stock price. So, the current stock price isn't being subtracted from the adjusted LEAP basis. It's being subtracted from the entire equation. That was the reason for the hesitation earlier. So that is the adjusted cost basis and the critical strike, sort of explained as best I can. And I mean, I'm definitely not the best. So hopefully it's somewhat understandable and easily, maybe, I mean, followable. Hopefully you can follow it. Yeah, other than that, those those two big things, they really make or break the trade for me. Other than your basic like setup and structuring the trade, those two are just absolutely important, and I know that I need to learn them even better than I already do now. But jumping over, shout out Your, if anybody's ever watched or read Spy Family, pretty good anime, I'd say. I kind of want to look at charts. I just want to mess around for a little bit and just go over some different charts and see if there's anything interesting this week. Like maybe I could throw on a short trade, on my diagonals and see if I can make a little bit more money. So the way things are going, if we just pull up, that's 2021. So we'll look at the last year. And we can see how XLF has been doing. That's the position that I'm in right now. Just to kind of, let's give it a reference point to the SPY. Pull up another. See how closely it's moving, because it's moving pretty damn close. And with the way things are going, like we are in a bear market, but this one looks, the SPY anyways, looks kind of bullish here. But the next question that's raised in my mind is, does the volume match the bullish moves? Does the volume match these bullish candles? So I wonder if it would be easier just to zoom in here, like the last 3 months, right here. Okay, so hopefully you guys can kind of see this as you're, like watching, or if you're watching this later on in the future or anything. You can see that we have 1, 2, 3, 4, 5, 6 bullish candles in a row right here. But the thing is, if you jump down here to volume, you have this huge spike on this. I think it's a doji candle. I'm not a chart expert. Please don't quote me. And then you have significantly less volume on this green candle, which has a huge bar on there. And then you have higher volume on the next one, which it has a larger bar, which is good. But there's less volume on the next one. There's less volume on the next one, and they're still going up. Price is still rising, but there's less and less volume. And then there's slightly more volume to the next one, the latest one. But it's kind of flattening out there is what it looks like to me. So, just these last 6 candles and these last 6 volume bars, just after taking a look at those, you can kind of see that it doesn't really look like, to me anyways, that price is going to keep rising up significantly higher. Like it's not really a bullish trend. If it was a bullish trend, all of those candles would have had volume in a similar, at least, pattern to how the candles are moving. You can see that the candles are rising up. You should be able to see that the volume is rising up as well. And if it was, then that would be pretty good bullish intent, but it's not there. So I'm still going to stick with bearish on the overall assumption, at least for the SPY. But looking at XLF in the last 3 months, we can see that it's definitely not the same. Like, I mean, they move in similar fashions, but it's just not exact. It's not an exact science. And we can see that, it looks kind of crazy right here. We can see all these moving averages starting to cross together and mingle and warp around. But right now, price has just crossed over the 20 daily simple moving, and it looks like, so we got the 10 there and we got the 5 there. So the 5 and 10, I'd have to zoom in even closer to really see these guys moving around. So we can see that the 10 simple, we'll get that one off of there. I don't need that guy. Yeah, get him out of here. So we can see that the 5 and the 10 exponential moving averages are just crossing over, and I mean, they're kind of like intertwining and moving around. And the 20 simple has just been crossed over by price, just been crossed over by the exponential moving averages. But looking at the 50-day, it's still so low, so low. I mean, it's so much higher than price right now, which still gives me that sign that, we're still in that bearish market. And there's no real signal to me here that things are moving higher. If anything, it looks like price is starting to move sideways. Like, we can see price came up on this hill right here, and price moved sideways. It's moving sideways. Boom, there's a decline. And then, price is moving down. It bottoms out right here at the 30. It moves sideways just a little bit. You got your 1, 2, 3, 4, 5 days in a row, kind of stuck in this range. There's 30, doesn't move higher than 31. That's like, what, 31.55, 31.60 you call it. And after this 5th day, boom, price jumps up. We go into the 32 range. It kind of peaks out right here at 32.84, call it 32.80. Peaks out right there, and then price starts to fall back down. But it doesn't fall back down to that low. It falls just above that, like 30-cent difference right there. So to me, that's a sign that price doesn't, I mean, this is the bottom right here for this specific window of time. This isn't the bottom for the underlying itself. It's not to say that it's not going to go any lower than this, but right here in this little snapshot, this is the bottom. Price comes back down. It doesn't want to test that again, so it moves back up slightly. And right here you can see that it's starting to move back up again, but I don't think that it's going to move and touch this height again. And I think it's going to it's tightening up right here. Price is starting to get more and more flat and move sideways, which could be an accumulation phase. And that could lead either to another decline, sort of like we saw here. So price starts to move up. It moves up. I mean, it touches higher a little bit, drops back down, evens out, drops. Evens out. I mean, it's up here on the wick, but on the actual bar itself, it's still relatively flat. And then we have, this last candle that's kind of sticking in this range. We can see how it's not really going too much higher. It's not really going too much lower than these other wicks here. And then we have this red candle followed by this red candle followed by, the next one. And when you start here with this red candle, we can move down to the volume bar. And we can see how it starts there. Volume rises. It drops further. Volume rises. It drops even further. There's a gap right there. And then volume rises again. There's another gap right there. And it's another red candle. So if we can take this example and extrapolate it over to this example, we would see volume rising exactly how it did right here over here. And that would give us a sign that it's a bullish move up. But it's simply not. So we're looking at this huge spike there. Get that out of there. And then we have this next, pretty big volume spike. Whoa. Whoa. I'm going to have to restart my computer. And we have this next volume spike, which to me, that's it's an odd move. I don't think that I can fully understand this or explain why there's such a large volume here with, this can only be buying and selling pressure to go further down. Seems like they wanted to keep buyers and sellers as they wanted to keep pushing it further, but buyers kind of pushed back here. That's why we have this huge wick on both ends and this really small candle. So after that, volume kind of starts to even out. Like we have these crazy days, and then volume starts to even out a little bit, and then the price starting to flatten out. So all in all, I'm still pretty bearish on the overall underlying XLF. Still pretty bearish on SPY. And for this week, we have the 15th July. I have one position open right now. It's a vertical position that's going to expire this week over here on the put side. I'm going to look to try to close that Monday or Tuesday. I really don't want to wait until later in the week just because everything's going to start to bleed out really heavily. So I want to try to capture as much as I can from that and move from there. And it's going to be a little bit harder because to come out really profitable on this position, just because you can see, dude, I don't know what is going on with this. This is crazy. I can do this, though, to get it out of the way and stop it from popping up, because that's fucking annoying. To close this out at a large profit, since it's in the money, I'm not going to lose much more, value through theta on here. So we're going to see how it goes. And looking over here on the extrinsic side, on Monday, I might be able to drop this guy in here, this 32 put, sell that, collect a 40-cent credit, and maybe I can close it out by Friday for a larger, maybe if I go 80%, maybe like 32 cent profit, 33 hopefully. There's a lot of open interest there. The implied volatility is relatively low, it looks like. And once again, we have a 47 delta. So it's not too crazy. Nothing too crazy. So I'm going to look at that. And that might be a position for me to get into. A really big thing that I need to pull up is the gamma. So let's just add this in here really quickly. Boom. So the gamma for that is 0.35, and that's going to affect my position as well. So if anything moves against or for me, gamma is definitely going to have to take it into consideration here. But other than that, I really don't have a whole lot else to talk about. So I'm going to go ahead and jump off here. Hopefully you guys have a pretty good Sunday. Hopefully you guys have a really good start to your trading week, and I will catch you guys next time.